Hello, this is Brian Rezny, president of Rezny Wealth Management and host of the Rezny Wealth Report. We have a great show for you this morning, and of course, if you have any questions about your investments, your retirement, please send those to Brian Rezny at ReznyWealth.com. You can also visit our website, sign up for a consultation, or download any of our groundbreaking free reports. One of our current reports that was newly released, 3 investment mistakes you must avoid now. It's free. Go to my website, ReznyWealth.com. We've got a great show for you again. We're going to make sure we educate you so you make great decisions around your portfolio. This show, again, is all about you, so make sure you do send us your questions. And let's get started with today's program. I want to talk about 6 investment pitfalls that you must avoid. I've been managing money for 30 years. And I often find mistakes investors make. I try to educate you about those. But these are 6 investment pitfalls that I find are repeated over and over and over again by investors. I want to make sure that you have the best chance for a successful portfolio and the best chance for a successful retirement. By avoiding these big pitfalls, you can definitely improve your overall financial security. I think too often, too many investors maybe don't spend the quality time they should looking at their portfolio and maybe not fully understanding. Today, we're going to give you those bullet points so you can make better decisions around your money. Investing is simple. You can just do it on your own with little online research and basic asset allocation websites. Sorry, that's false. I see a lot of commercials from a lot of the different online discount brokerage firms. Investing simple. Pick up your smartphone, look at a chart, trade while you're at dinner with your wife or your husband. It's not that simple, folks. It takes a lot of time and discipline. But unfortunately, people will get lulled into something simple. Simple is not necessarily good. Neither is really complicated. But you as an investor have to understand, anything that's going to give you a benefit is going to take time, and time is ultimately going to give you the education you need to really produce returns in your portfolio. So never fall prey to things are super easy. It's as easy as buying this or selling that. Often it requires a lot of daily research and a lot of time on your part, and if you're unable to do that, find yourself a fee-only fiduciary money management firm that can do the heavy lifting. And remember, make sure you hire the right firm so you don't go through the pitfalls and the conflicts that are often prevalent in Wall Street firms, banks, and insurance agents. Low-cost investing equals successful investing. Again, this is not necessarily true. Just because something is cheap doesn't mean it's necessarily good. But one of the things I want to stress is when you buy things that appear to be low-cost investing, and I see this a lot from people who were sold annuities, and they were told annuities have low cost or no cost. That's a blatant lie. But people will get lulled into the fact that, hey, I'm not paying a commission, but you're paying a lot of fees internally. So remember, low-cost investing or no commission doesn't necessarily mean you're not paying a lot of internal cost structure. You as an investor need to do some homework and make sure, are you really getting what that salesman is touting, or is it smoke and mirrors and it's costing you a lot more in return through underlying expenses that are buried deep in that really thick prospectus? Stock market plunges are brief, and you make up the losses in a reasonable period of time, so hang on there. No. I will often hear from new clients that hire my firm that their old brokerage firm said, hold on, things will come back. And a lot of those things never came back. We do not believe in hold on, things will come back mentality. We believe in active research and active risk management. It doesn't mean you're buying and selling every day. But what you have to understand is this. There are times that the market has short-term corrections, or any investment has a short-term correction. The key is it time to make changes to that portfolio? Is that small drawback in the stock market going to lead to a much bigger drawdown in the stock market because, let's say, we're entering a recession? These are the important points about research. And again, active money management, active risk management. One of the things that I often find investors don't do is they don't have a way to mitigate major catastrophic downward risk like in a recession in their portfolio. Here's a fact. your broker doesn't either, so don't let them kid you they do. Most brokerage firms don't manage money, they sell investments. You're really managing your own money, but you didn't probably know that. So make sure you understand the difference, because your retirement security really depends on the difference between advisory and brokerage, and what you need to do or not do, and what your advisor's real responsibility is. Even if the stock market falls hard, bonds, the go-to asset class for capital preservation, will rise and offset much of that in the financial pain. Not true. One of the things that I think investors were somewhat misled on is the old asset allocation approach, which is put some money in stock and some in bond. The difference is, 20 years ago, yes, bonds did pretty well going into a recession because interest rates were much higher and the Fed slowly reduced interest rates, which had bond values increasing in value. Today, we're at very low interest rates. The benefit of bonds in a portfolio as a buffer or a safety net, as we call it, are not going to be as good as they once were. Meaning, the Fed can't reduce rates 2 or 3 percentage points because 10-year bonds are basically trading around 2.5 to 2.75%. So what you have to realize as an investor is rates cannot come down as much as they did in the past. Bonds are not going to be the buffer they once were. You have to understand your opportunity then is, do you start hedging, meaning inverse type investments against your stock positions, or do you sell some stocks heading into an overheated economy or recession? That's an important point, and risk management is very important in the money management process. Alternative investments such as gold, real estate, non-U.S. investments act as antivirus in times of market turmoil, and again, that is false. I will often have investors that will come from the brokerage houses or banks, and they have something called asset allocation, these pies, where their investments are spread all over in 30 or 40 different investments. And they're told by their broker advisor that, hey, we're diversifying the portfolio from market risk. That is false. If you look at statistically, if the market goes down, whether you're in U.S. stocks or whether you're in international stocks, those stocks will pretty much all come down, and often the international ones or emerging market stocks will come down more. So what you have to realize is, just because you have a portfolio that appears to be well diversified, the exposure may have the same amount of risk as just being in the pure equity market. And again, this is why risk management is important, and not just blindly spreading your money all over the place and forgetting it and let it ride. Not a good strategy at all. Think your advisor is really managing your money. I kind of talked about this earlier. One of the false pitfalls that investors often overlook is Wall Street firms, banks, and insurance companies often work under suitability. They're working under what's called sales. Most of these firms, or in a brokerage account, your money is not actually a managed account, meaning your advisor is really acting as a broker or salesperson and not managing your money at all. When I often have a new client that will come in and talk to our firm about hiring us, and I explain that they actually don't have an advisor at all, and they don't have an advisory agreement, they have a broker and a brokerage account and a salesman, they're kind of shocked by that. And they say to me, Brian, are you telling me that this person never really was in charge of managing my money before? And I said, probably not. Again, there's a big difference between sales and brokerage and advisory. Know the difference. Do not falsely believe that your broker is really managing your money or knows what they're doing. I'm going to take a quick break. Send your email questions to Brian Rezny at ReznyWealth.com, and please visit our site, ReznyWealth.com. Sign up for a consultation. I'll be right back. Hello, I'm Brian Rezny, president of Rezny Wealth Management. Is your broker working in your best interests, or are you being sold inferior investments by Wall Street firms and annuity salespeople? My advice, never settle for bad advice if you value your financial and retirement security. Real money management, real advice is the difference my firm provides. Call us today and schedule a consultation. And we're back. Make sure you send those questions to Brian Rezny at ReznyWealth.com. Visit our website, ReznyWealth.com, and call our office for a consultation. Never, ever settle for bad investment advice. Your retirement security, your portfolio, think about this. You only have one retirement. You only have one portfolio. Do not let bad advice negatively impact your money. If you're finding your advisor is not up to par, if you're not happy with the returns on your money, if you're realizing your advisor is more sales than money management, it's time you schedule the consultation with Rezny Wealth Management. Experience the difference we offer. Let's sit down. Let's review. It doesn't hurt to talk and get a second opinion. Call the number on the bottom of the screen or visit our website, ReznyWealth.com. Janet from Chicago, Illinois. I've heard a lot about sell in May and go away strategy. Is that a valid strategy and does it work? Janet, there's been a lot of studies, and this is a kind of a Wall Street narrative that they've been popping out for years, which is you sell the equity market in May and basically you come back in November scenario, and then you kind of miss these bad months. It doesn't work. I've looked at literally dozens, if not hundreds of different reports and studies on sell in May, go away in the stock market. And if you look at it over a rolling 5, 10-year period of time, it basically, you're actually better off to be in the whole time than be out. So don't go by sell in May. That's not a strategy. You'd also incur a lot of short-term capital gain if you're constantly buying and selling. What I would say is develop a real strategy that really is around a relative strength on earnings and performance based within those asset categories you own, and then make sure you follow it. If you're unable to manage your own money, Janet, I would suggest you call my office, schedule a consultation, get a second opinion, and we'll show you how real money management is done so you can hopefully prosper and have that secure retirement that you really have always dreamed about. Bob, Fort Myers, Florida. Should bank stocks get a boost from the Trump presidency? You know what? Generally speaking, this is what's going to happen. Bank stocks for a long, long time have really kind of lagged other parts of the market. What's going to drive bank stocks is interest rates. If the economy is doing better, which it appears it is, and it is getting a little better under the Trump presidency, and again, from reduced rules and regulations, the economy is getting better. The Fed has already raised rates a few times this year and expected to do more in the future if the economy stays strong. Higher interest rate is really what will boost bank stock earnings. If they make more money, bank stocks have a chance to go up. Bank stocks currently, in our role, we look at them as value stocks, meaning they're underpriced in the market. They're anticipating higher rates down the road. As long as rates move up slowly, I think bank stocks have an opportunity, and I really do enjoy the value side of the market today simply because the growth side, to me, has really been chased and kind of overvalued, and value is much cheaper than the market, and bank stocks fall in that category. But stay diversified. Gary from Fort Myers, Florida. Do you know where I can invest some money, say $200,000, and get 4 or 5% in a safe return like a CD account or CDs used to be? Gary, there is no place, nowhere in the world that you can get safe returns of 4 or 5%. It's not going to happen. If you want safe returns, you're going to put your money in a CD. You're going to make 1 to 2%. And that's going to be about it. Anybody who tells you you can make 4 or 5% safely is lying to you. I will tell you that I get a lot of phone calls in my office, on my TV show, on my radio shows on Sunday, and people will ask me all the time, well, I went to this free steak dinner seminar, and the guy was pushing these annuities, and he said they make 8%. And I said, the guy's lying to you. No annuity pays 8%, not real money on your money that you could take out tomorrow that's actually earnings on your money in your real account. These are fake propaganda, and to me, what I call them lies and half-truths by these annuity sales people. Do not believe 4 or 5% returns, and never believe an annuity is going to pay you 8%. Those are blatant lies, often to mask the real underlying crummy investment. And remember, it's your, you have to look at the facts. You have to look at the fine print as an investor. Too often, investors will hear these returns that sound really good, but you don't do your research. You get locked in. you have big penalties to try to get your money out, and then you realize you made a big mistake. Before you get suckered into investments that don't really pay 4 or 5 or 8%, you need to read the fine print. None of them do. It won't come on your money, and you're not going to be happy once you get in. Bill from Naples, Florida. My broker keeps suggesting a variable annuity for my IRA rollover. Bill, your advisor is a salesperson of annuities. They're not an advisor at all, okay? The only real advisors are fee-only fiduciary money management professionals. Your person who's selling an annuity is not fee-only. They're a salesperson. Never, ever put your money in an annuity. There's much better ways to do it. Variable annuities have high expenses that come against your real return. I'll give you an example. I've been managing money for almost 30 years. The average variable annuity that we've reviewed, and we reviewed hundreds if not thousands over the years, the average one that I've looked at has an annual expense ratio often between 3.5% and 4.5% a year. That's a lot of expense. So if your money makes 5%, and then you take 4.5% against that for expenses, you only made 0.5% on your money. Think about that. Annuities are only good for the selling broker agent and the insurance company. They're not good for you. Do not let your broker talk you into doing that. I would suggest you call my firm, schedule a second opinion consultation, get some real advice instead of being sold down the river. Robert from Fort Myers, Florida. Do you use charts and are stocks overbought based upon technical indicators? Robert, we use charts a lot at my office and my firm for money management research. We like charts. We also do a lot of fundamental research, but we like to use charts in addition because it shows a nice picture. You get a direction of what an asset category or a particular investment is doing, which way is it moving, and there's other short-term indicators you can overlay on charts. Charting is pretty technical. It's pretty complicated. We've done it for a long time, but I do like charts. If I look at charts, it depends what stocks. Some stocks are grossly overbought. Some are not overbought. The key is match fundamentals with what you're buying. Are the fundamentals reasonable? Is the stock not overvalued? And is the chart pointing in the right direction with various indicators? It might mean it's a great opportunity, or it might be a continued hold in your portfolio. Rick from Florida, when do you sell a stock you bought? That's always been hard for me to know. Rick, the hardest thing for most investors is selling. People will buy stuff pretty quick without doing a lot of research, to be brutally honest with you. But when it comes time to sell, a lot of investors have no sell strategy. So what happens is this. You buy XYZ stock. You're hoping it's going to go up. But all of a sudden it goes down 20% in value. Most investors don't want to sell because it's down 20%. I'll wait till it comes back. Then it drops another 20%, and now you don't want to sell for sure because you're down 40%. And people think just because a stock drops or an investment, it's magically going to come back. There's a lot of investments, folks, that never come back. You need to have a sell strategy before you ever buy any investment. Stocks, real estate, bonds, gold, it doesn't matter what you buy in your portfolio. As an investor, you need to have not only a buy strategy, you need to have a sell strategy. That's what money management is all about. If you don't have your own sell strategy and you're not properly managing your own money, it might be time you called Rezny Wealth Management, schedule an appointment, get a second opinion, find out what real money management is and how it can benefit your retirement and financial security. Ben from Fort Myers, Florida. What do you think about variable annuities? Are they good for a retirement account? My broker is pushing hard on a Prudential variable annuity for my 401k plan rollover. Ben, just like my last question about annuities, annuities do not belong in your retirement account. And I would not buy any annuity. Annuities have high expenses. You could buy something else, a different investment, a portfolio of ETFs, at a significantly better, different overall cost structure. This is what you have to look at. If you buy an annuity, a variable annuity, and if the average one has a cost structure of 3.5% to 4.5% as a number, let's say it's 4 to be average, and you could build a portfolio of low-cost ETFs that cost you 10 basis points a year, 0.1%. Are you better off investing your money at a 4% cost structure or a 0.1% cost structure? Well, of course, cheaper cost structure. If you're taking the same amount of risk, you're going to keep a lot more if you have a lower cost structure than if you buy an annuity with a high cost structure. The problem is investors don't read the fine print and they really don't understand the cost structure of annuities. Your broker wants to sell you what's good for your broker's pocket, not what's good for your money. Never buy an annuity, ever. There's better ways to do it, cheaper ways to do it that are more beneficial for you. I'm going to take a quick break. Visit our website, ReznyWealth.com. Make sure you send me email questions to BrianRezny@ReznyWealth.com and sign up for a consultation. Get a second opinion. Let's get you back on track. I'll be back after this. Hello, I'm Brian Rezny, president of Rezny Wealth Management. Is your so-called advisor really just an annuity salesman? Fact. Annuities are sold by misleading you, the investor. Sky-high expenses, crazy surrender penalties, and mediocre investments rob your returns and rob your security. My advice, stop being sold. If you want real money management, real advice, call my firm today. Hello, I'm Brian Rezny. Back. We're going to go through some more questions today. Make sure you send your questions to BrianRezny@ReznyWealth.com and visit our website. Sign up for any of our groundbreaking reports. Our recent report, 3 Big Investment Risks Investors Must Avoid Now, is important, especially if you're a pre-retiree, if you have at least a $500,000 portfolio. This is a must-read special report. If you care about your money, the security of your wealth, and your future, read the report, learn the information, protect your family's security. This is a great read for you. Jerry from Naples, Florida. Hi, Brian. The market's has really rebounded. Do you think all the recession and fears heard by Wall Street are overblown? Jerry, let me tell you what. I don't know if it's every week, every month, certainly every year. I hear Wall Street firms, banks, insurance companies all the time talking about the next big market correction, the next recession. I remember in 2015, calls for recessions from a lot of the big firms. 2016 again, calls for recession. Of course, now you're in 2017, same thing. Bottom line is this: recessions will come again. Currently, we're not seeing the signs of recession. That doesn't mean we're not going to get a pullback in some of the investment markets. We traditionally get one of those every single year, and that doesn't mean that the market's going to be down for the year. It means you got a temporary pause that hopefully refreshes, and then we go to hopefully new high ground. That's traditionally what's happened for long-term investors. But recessions do come and go, about every 6 to 7 years. Sometimes they're 15, 16 years apart. The last recession we had, by the way, really started in 2008, ended in 2009. I would not listen to any of the information you get from these Wall Street firms. These firms have been wrong about so many things for decades and decades. The information they spew is really conflicted information, probably in order to get you to trade more, buy more of their crummy investments at high cost. Follow a strategy. Do proper research on recessions. We do that at our firm. And when it's time to get defensive, if we see signs of recession, we'll try and alert all of our TV and radio listeners. But that's what we do in-house. We do a lot of research. We look at recessions. If we need to get defensive and conservative, you do it then. But certainly, don't take the advice of Wall Street. They haven't worked out well in the past and probably won't work out well in the future for your money. Tim from Cape Coral, Florida. Where are the best opportunities in preferred stocks? Good for income. Tim, preferred stocks are a hybrid between common stock and kind of like long-term bonds. I'm not a big liker right now of preferred stocks because they really act like longer-term 30-year bonds. They can have a lot of volatility going into a rising interest rate environment. I would rather look for something more like total return. Growth of my money plus a more moderate dividend stream gives you the combination of the two. So look for total return. I'd rather be looking at more the equity markets, diversified index within the U.S., or even potentially some in the emerging markets and small cap in the U.S. As opportunities for your money. But I would really stay away from preferred stocks at this point. I think valuations, interest rates, I think there's better opportunities elsewhere for your money. Sherri from Fort Myers, Florida. How can I find a fee-only financial planner? Excellent question. I wish more people ask questions. How do you find a fee-only firm? Before I go into that, first off, there is not one bank, not one Wall Street firm, not one annuity salesperson that is a fee-only firm, because they all sell products. Some might do fee-based. A lot of them sell commission products, or all do. Bottom line, none of those firms are fee-only. The only kind of firm you should entrust your money to is a fee-only firm. And don't let somebody bamboozle you with all kinds of rhetoric and talk. Fee-only is fee-only. Eliminate the conflicts. A fee-only money management or advisor works for you. That's it. Anybody who works at a bank, insurance company, or Wall Street firm is working for that company and not in your legal best interest. Find a fee-only firm. Go to my website. You can download for free. We've got a free report. It's called Your Biggest Investment Risk, Fiduciary versus Suitability, and there's a questionnaire. I would start there. I would download that, utilize that. Then what you want to do is utilize that questionnaire. It'll tell you about the different kinds of firms. Utilize that questionnaire when you interview various firms. I'd say interview us also, because we're a fee-only firm. And make sure they sign off that they are a fee-only fiduciary firm, because that's your best shot. Interview, ask those simple questions we give you in that report, and that way at least you can know the questions to ask and be more able to make a better choice on who you are going to entrust your money to. Doug from Cape Coral, Florida. I've just inherited a chunk of money, but I know nothing about investing. What should I do? Hire a professional. Hire a fee-only fiduciary money management firm. Go to my website, like my last question, download our report, Your Number One Investment Risk, Fiduciary versus Suitability. Read it. Read it twice. Utilize the questionnaire. One of the things you want to do is, if you could start off hiring the right firm to manage your money, hopefully it'll be the last firm you ever hire. What I typically find, most people that hire my firm have already been through 4 or 5 or 6 other Wall Street firms, and they've never been happy. Then they learn about fee-only money management. Start there first, and I think you'll be truly happy. Folks, I'm just about out of time. My advice, when you're ready for your financial interest to come first, let's talk, let's review, put your family's financial security always first. Don't settle for bad advice. Get a second opinion. It's time you secure your financial future. Call my firm, numbers on the bottom of the screen. Go to ReznyWealth.com. Do not settle for bad advice. Get that needed second opinion. We'll see you next week.